Good morning, everyone. Today is Tuesday, March 16th. I'm Joanne Koontz. I'm here with my partner, Jackie Durham. And although we have survived the March 15th business tax return filing deadline, I promise Marina survived. She's not joining us today because she's got some well-deserved respite in her orbit. So we gave her the day off. So you just get two lawyers. Nonetheless, we wanted to talk to you today about closing costs and how to handle closing cost credits if you are in a transaction. We're anticipating the bulk of our participants today are likely to be real estate agents, but if you happen to be a person who is involved in a transaction, it's still helpful to know. Oftentimes what we see are folks who are navigating their way through the transaction maybe for the first time or few times in your life that you're buying and selling a property. And so it's important that your closing agent and your real estate agent are seasoned and experienced when it comes to negotiating the financial arrangements of your transaction. So it's real easy, especially when in this market where things are super hot. The popular word of the day is for sale by owner, and people think they're going to save the real estate commissions. And it's places like this where when you're on your own without the benefit of a realtor, that you can kind of get into some trouble if you don't know the lay of the land. So wanted to kind of talk about that. As always, we are delighted to field your questions as we go. There's a Q&A box at the bottom of your screen. If you can use that, that'll help us get you answered while we're in the middle of these examples. So wanted to kind of go through some more stories and see some of the things that I see and some of the things that cause some trouble for folks. Firstly, you come to the real estate transaction, you negotiate your purchase price, your earnest money deposit, your closing date, and usually the first hurdle is inspections. Inspections have a tendency to happen pretty closely to the time frame that the contract is entered upon, and let the games begin. So invariably, something is amiss, and this is irrespective of the fact of whether you've signed an as-is contract or a repair limit contract. This discussion still comes up. So the buyer has the home inspection and an issue is identified. And depending on the nature of the issue and depending on the type of loan, if the buyer is taking a loan, that is something else to consider. If the buyer is paying cash, now we are not governed under the RESPA rules, which is the federal guidelines regarding mortgages. And I don't want to say you can do whatever you want, but you almost can do whatever you want. If it's a cash purchase closing and there's an issue with, say, the air conditioning or the electrical or plumbing, seller can just credit buyer, and buyer can take that money and complete the repairs after closing. And we have hold harmless sign that say, hey, this is in satisfaction of that. So seller's not going to owe buyer anything. Buyer is not going to get anything from the seller. The risk here is if you don't get enough, if you say, oh, the plumbing is going to be 10,000 and it comes in at 12, buyer can't go back to seller and say, hey, it's 2 more, hand it over. If you've taken that repair credit in lieu of the repairs, you are satisfying that yourself. Sometimes for folks, it's a good negotiating tool. Maybe the husband is a plumber, and so he can do it for less than the estimated quote. And so seller gives a credit of 10,000 and Mr. Buyer can fix everything for 2,000. Then, kudos to them. They've gotten this benefit. If it's not cash, we need to be super cautious about how we negotiate how the repairs are going to be treated. So oftentimes what happens is I receive a phone call from a frazzled real estate agent who says, okay, I finally put this back together. Buyer and seller have agreed, and we are going to reflect a $10,000 credit. Okay, great, but Mr. Buyer's getting a loan, so we need to be careful about the manner in which we craft the language to express the repair. Depending on the type of the loan that the buyer is taking, some lenders are fussy about seeing major repairs. Air conditioning, electrical, plumbing, those kinds of things. They're not keen to seeing AC repair on your repair addendum. What we don't want to do, in which I've seen a few times, is where an addendum is created and at the top it says, do not send to lender. Do not do that. That is fraud. And we don't do that here. I know it's common in the furniture world. It's still not permissible. There's still a better way to address that. That's a spider web for a different day, though, on the furniture. But when it comes to the repairs, you just need to be very cautious. If you are the real estate agent and you have gone and negotiated a $10,000 credit, and we word it properly on the closing statement, but we have not been mindful of what the closing costs are going to be for the buyer, we could run into trouble there. So it's not just in how we word it, in how we express this credit to the lender, but it's also in making sure that, especially if you're the buyer's agent, ensuring that that credit got used up. So you don't want to negotiate for a $10,000 credit that covers closing costs and prepaids, and then only $8,000 of those costs exist. That $2,000 will be left on the table. The buyer cannot get a credit in excess of what the closing costs and prepaids are. So before you open your mouth, it's good to have that dialogue with your buyer, but you're going to want to go back to the closing agent and really see if you can start to get an estimate of those closing costs and what we expect to see on that closing statement before we go and say, oh yeah, we'll accept $10,000. Maybe not. Maybe it's going to need to be a purchase price adjustment, or maybe it's going to be closing costs, prepaids, and some combination of maybe a purchase price adjustment. We're not keen to jumping straight to the purchase price adjustment, but I don't want to ignore that as sometimes the manner in which you ensure that the buyer gets the full credit, because it's really ugly at the table when the buyer finds out that they have been shorted some money that they were anticipating. And at the table isn't when we want to see people be upset. So if we can have this conversation kind of early in the transaction, it's much easier to plot and plan. Things that are included in closing costs are title insurance, documentary stamp taxes, recording fees, lender fees. You have to be real careful when you're shooting from the hip on lender fees, though, because oftentimes the lenders will also give an offsetting credit. So if the lender charges, say, a $4,900 fee, but then credits the borrower $3,700, you're not going to have that full $4,900 to play with. So you've got to be mindful of that as you are, wandering through that. And you really need to have a handle on that before you've really opened your mouth to the other side. So it's a little bit of a balancing act to make sure that you've got everybody in terms of an agreement, like we're in concept on the same page, but before we've nailed down the appropriate resolution, you don't want to spend time and energy and burn negotiating capital on coming to an arrangement that's ultimately not going to work. And then you come back to the seller and say, oh, by the way, and we need $2,000 more here. It's better if we can know that up front. It's not the end of the world. Depending on the seller, you may have somebody who is easier to deal with. We seem to be on a run right now of folks that are maybe not the most flexible. Is that a nice way to put it? You're better at those things than I am, Jackie. But it's better to navigate those things ahead of time if we can. And also it helps to know the parties. There are some times when I'm having a frank conversation with the realtor and I just say, look, what do you think lands better? Sometimes the seller is going to be adamant about wanting to fix it. And sometimes the seller is going to be adamant, I've already gone out of the country. I've gone back home. I have no way to get there to fix anything. And so they just want to throw money at the problem. And the flip side, the buyer may or may not be willing to have money thrown at the problem. The buyer may say, I am not interested in a credit. I want it fixed. I'm moving. I want it turnkey. I'm unpacking from, pandemic lockdown in New York, and I just want to set my stuff down and go to the beach. So those factors always have to play in. This is not just simply a numbers game. You're always going to have that variable of the dynamic of the parties and what's going on to consider as well. I don't in any way, shape, or form mean to ignore that. But it's something that needs to play into that. So we just want to make sure that there's no money left on the table, because people are super ugly when that happens. And I'm just looking at the panel, at the list of attendees, and I see some folks that have experienced these troubles before, because I've helped them navigate that. Not fun, but we do what we can. So other types of closing costs that we need to be mindful of are things that may not be anticipated if you aren't out in front of the conversation ahead of time. So oftentimes, if you've got a borrower who is buying an investment property or a rental property, they may be contemplating putting the property in an LLC. And if so, Oftentimes lenders are telling them, just move it afterwards, buy it in your individual name and move it afterwards. And there is absolutely a lack of appreciation for the duplication of closing costs. Hi, Jane. Sorry. The lack of duplication of closing costs with the documentary stamp taxes being doubled. Those transfers are still taxable with the state in terms of the outstanding mortgage balance. And that's not going away even if you're transferring from yourself to your own LLC. We've had some ugly ones of those rolling through recently as well. And if you've got that as a part of your instant closing, those closing costs may be there twice as well. So if that's going in and out in the same deal, that may be going out. Sorry, it's a home day.
Oh.
We're not feeling so hot. Questions before I move on. She's cute. Thank you. She's
adorable.
Not feeling hot today. It's okay. Okay. So, Jackie, anything else I'm not covering there?
No, I mean, I think that last point about the fact that lenders will come up with all sorts of solutions and say, yeah, no, just transfer it after the fact. And a lot of times there's not a lot of planning and the parties aren't necessarily consulting with their attorneys. So it's really important to not only have your attorney review the contract, but also review any changes you're making to things like vesting of title, because that can really smack you with extra expense that you're not expecting. So that's a great point.
Absolutely, absolutely. If we also have, you know, the bringing us in early is really the key to this that I really want to drive home. We also sometimes see where if their parties do need maybe additional closing cost credit, depending on the time of year in which we're closing, be mindful too, and to count into that closing cost credit, that if we're closing nearer the end of the year, the seller has a responsibility for proration for real estate taxes that's going to be credited back to the buyer. And so that's going to have an impact over the beginning of the year versus the end of the year. So it's not just a like rundown of these are the types of expenses, but also be mindful of the time of year with taxes, CDD fees, things like that on when those are due.
Right.
Okay. Questions, concerns for the good of the order.
Go ahead. I don't know if you're going to touch on this at all, but I feel like we're seeing this more often, but the FERPTA withholdings, which a lot of folks seem to gloss over, but that's, I think, a really important one to touch on as well, because that can be missed sometimes, and that's sometimes a surprise. If there isn't a proper FERPTA addendum or something like that to the contract, it can create some surprises for parties when there's this withholding that's required at the time of closing.
It can, and keep in mind the FERPTA withholding is not a closing cost for purposes of giving these credits. So if there's a repair, that FERPTA withholding is actually a source of confusion. It does come out of the seller's proceeds, although the wording of it is that the buyer is responsible to do that withholding. So sometimes we do see people saying, hey, well, I'll eat up some of that. No, it doesn't work that way. So that FERPTA withholding has got to be on the seller's side. Even if there's a withholding certificate, it's still got to be withheld on the closing statement. And then when the withholding certificate comes in, it'll be distributed to the parties, to the IRS and the seller as appropriate based on the withholding certificate approval. But those things are not going to be included in the closing costs and prepaids. Now, one last thing I kind of wanted to hit on was what's tax deductible out of your closing costs. So a couple things to keep in mind here. We frequently field the question about CDD fees. There is a big bunch of differing information if you Google, which is dangerous. CDD fees are not tax deductible, despite the fact that they appear on the real estate tax bill. So in terms of what's deductible, if we're doing the taxes for somebody who's bought or sold a property, if you've bought, we're taking your real estate tax proration piece, that's going to be deductible. And if you're selling, we're going to have the real estate commissions. If the seller has paid title insurance, that's deductible. So those things are, especially if you're calculating, in the sale of the property, what's going to go into capital gains, those things are going to come off. The real estate commissions will come right off the top. Documentary stamp taxes, however, do not come right off the top there. We have a question about commissions being calculated with a credit as opposed to a reduction in the purchase price. The realtor may give a credit, but if we do that, then the credit is coming from you and not from the seller. We still need to get that approved. I need you to sit down. We still need to get that approved by the lender. That's not something, oftentimes realtors do participate, unfortunately, to bridge a deal together and say, you know what, the buyer and seller are $3,000 apart and the two agents are going to kick to meet the difference. That's permissible. It's not coming out of the seller's column though. So that's eating into the agent's pocket, which is not where we want to start. However, that does still have to be approved by the lender. There are rules depending on the buyer's loan product that they're going for. If the realtor, for example, is kicking in some commission, the buyer is not typically going to be entitled to take a refund at closing. So what we'll find is you may want to participate, but if the buyer already has a low down payment loan, and you give $3,000 in commissions, that may put them into a refund balance and the lender may not permit that. So sometimes what we see there is the agent might go and pay things directly, like the home warranty or maybe to change the locks or something like that, that still gives the buyer some value, but in a way that doesn't diminish the credit that's going to them. You know, or another thing that comes up as a solution to this is if we can't get this to work out, is we'll have the seller pay the vendor that's going to be used for the repairs directly. So that's something that's been super successful. It gives the buyer peace of mind that the work will actually get done. The seller's electrician or plumber can be paid, and you know, the buyer has opportunity to speak with them to ensure that they're not just going to refund the money back to the seller, and that ensures that somebody will actually come out and do the work and stand by their estimate. So that's another nice way that happens off the closing statement, and it is perfectly legitimate. We're not dodging RESPO or any of the required rules, but that's usually my go-to if we're talking about a large dollar figure that, you know, if you start getting over $7,000 to $8,000 in the repair credit, you're usually going to run out of runway unless it's a really high dollar value, you know, unless you're in excess of $1 million on the property purchase price. It's just, they're just the closing costs. Although the people from up north think that that our closing costs are high because they don't pay doc stamps because they pay income tax. Those things are typically not high enough to start outrunning huge repairs. We do have one question, Linda. Hi, Linda Zufa. We did seller prepaid, realtor bonus commission, and realtor paid the vendor for the repair after closing. Is that okay? Realtor can pay the vendor, no problem. That's, you know, that's not an issue. Like I said, we just want to be very careful about making sure if we've negotiated for the seller to pay, that the seller is paying and not the realtor. Because sometimes we're making the buyer happy, but we're at the end of the day not making the realtor happy, and the seller's getting off without having made the repair. Liz says, when a seller is picking and paying title and is responsible for the owner's policy, but the breakup of the owner and lender policy is done differently, now is seller paying for the owner's policy for the actual cost or the way the buyer's lender requires it to be broken down? Florida law is still the owner's title premium is set and the lender premium is $25. That title premium disclosure that you see executed at closing that shows the comparison of federal to Florida is just balancing the TRID requirements for disclosure. It's not changing the actual purchase price of the title insurance. So if the seller is paying for the owner's policy, the credit that they give to the buyer on the closing statement is still going to reflect the full amount of that lender policy. If you look of the owner's policy, the lender's policy component will be the lender's premium. It'll be any endorsements, the survey, you know, Form 9 or any of the other 4.1 or whatever endorsements are on that loan policy as well. Those would be the only things that would be charged to the buyer or not credited back. Okay. Questions on any of that? Clear as mud? Perfect. I think we've caught all of the questions. This is not a terribly meaty topic, but it is very important strategically. And that's really what I wanted to draw attention to, is really be mindful that there are multiple ways to approach these situations. And the most critical component of this is to be mindful to just have these discussions privately and in advance. And I don't say privately to have some Enron dark room where something shady is going on, but huddle up with the buyer's lawyer or the closing agent and the buyer and the realtor, and let's talk it out, because oftentimes what makes the party satisfied, that's really what we need to make sure we accomplish. And we don't want to to overlook something that is of import. And sometimes I know it's coming down to, you do the inspection and there's 50 things on the repair list. What are we going to ask for? And sometimes people say, look, it's a bunch of little things. There isn't one big thing. And that's why I want to do just one number. Like there's GFCIs aren't working and, just little things. That part you are going to want to be, just mindful of what the goal is first, and then how do we most efficiently achieve the goal. Because like I said, sometimes it's like, oh, eureka, this is the solution. Seller said they would do X, and everybody runs off and drafts an addendum. I just would have some discussion before that happens to ensure that what we've got is a permissible situation, or even if it is permissible, maybe it's not ideal. Maybe there's a better way to reflect it. So if we can just have a quick huddle, those things are easier to ferret out if we're having a discussion. So that's closing costs in a nutshell. And
do you mind repeating real fast what those tax deductible items are?
Certainly. So if you are the seller, you are going to have as a deductible item your real estate commissions paid upon the sale. If you are the buyer, if you've paid real estate commissions, sometimes we do see folks have their own buyer's agent and they're paying them. Those are added to your basis, which is added to the purchase price of the property. So later reducing your capital gains. So commissions are always on the table. The title insurance premium is for the buyer. Not tax deductible on Schedule A if you are buying your primary residence, but if you have a rental property, that would be included in the basis. It's not deductible as an expense, but it adds to the purchase price of the property. Same thing with documentary stamp taxes. We can throw that into the basis as well. If you're paying doc stamps, that's going to come into that calculation. And then any allocations or prorations for taxes, for real estate taxes that are being paid, not for association dues, unless it's a rental property. Those are deductible in a rental property, but not a personal use, not a primary residence or a second home. And then your mortgage interest that you pay, if you have a prorated amount of mortgage interest, that'll be reflected on your closing statement as well. That should end up at the end of the year in your 1098 from the mortgage interest, from the lender, showing your mortgage interest statement. Yeah.
Let's say that I'm the seller and I'm paying the doc stamps. Is that amount going to reduce my gain?
Yes. Documentary stamp taxes paid on the sale will reduce your gain on capital gains calculation. It will not be otherwise a tax deductible item on your Schedule A of itemized deductions.
And I know these aren't as common, but prepayment penalties, would that also reduce my gain?
Yeah, prepayment penalties are actually deductible on the mortgage interest line, as are points. We also don't see points very often in residential transactions at this point. We do see them in commercial transactions still, but if there's points to take the loan, you see them occasionally in residential, but normally they're wiped out with a lender credit. So those points are also separately reported on the 1098 mortgage interest statement. So your CPA should see that when they prepare when you gather your documents to prepare the tax return. That's not necessarily something they need to grab on the closing statement. It's nice for planning purposes, and of course there's human beings working at the bank, so occasionally you do see some errors on those 1098s where you would catch it if you had reviewed the closing statement. It's most important that you have that closing statement on the purchase and sale side in a rental property situation and also in a FIRPTA situation. In a primary residence, if you're married filing joint and you were in the property for 2 out of the last 5 years, you're going to get a $500,000 gain exclusion. So for the most part, folks aren't really dealing with an actual capital gain to pay on a primary residence. If the market stays the way it is, then we might run into that because it's super healthy and sellers are enjoying some nice upticks in values right now. But typically a single person gets $250 and a married filing joint couple gives $500,000. And so that's usually enough to outrun whatever capital gain they've got.
One last little question. How about insurance? How is that?
Insurance is tax deductible on Schedule E of a rental property as an ongoing expense of your rental, but it is not deductible if it's your primary residence or your vacation home. Those things are just kind of the ongoing maintenance expenses, and those are not deductible unless it's a business property. If it's a rental, everything is deductible. Insurance, utilities, taxes, you know, repairs, anything like that. Speaking of repairs, anything that you might do, let's say that, you know, we do have to do new AC or plumbing as a result of this inspection. If the buyer has paid for that, then it is going to be reflected in the basis. It's going to increase whether they do it at closing or do it later, or do it 10 years from now. The roof needs to be replaced. Those things all increase anything that increases the life or value of the property. So things like roof, windows, AC, plumbing, electrical, it's not cosmetic things like just changing the paint color on the wall. That, you know, think of it like people, if it just makes you prettier, it is not deductible. But if it's, you know, changing the value or the useful life of the property, then it is included in the deductions. So that's tax, legal, closing statements, everything all in one big messy bundle. I hope this is helpful. If there are no further questions, I'll let you guys go. Anything else? Going, gone.
I don't see anything.
Perfect. Jackie, thank you as always for your time. Keep in mind, everyone, these webinars are recorded weekly, and we do distribute them for your viewing pleasure. So you can share and circle back if there are questions that you have. Next week, we're going to be talking to you about individual taxpayer identification numbers. Do you need it? How to get it? If you are dealing with any kind of foreign buyers or sellers, this is something that may come up for you. And there's a lot of rules, and they've all changed recently. So we need to be very mindful and careful about relying on what our foreign sellers are saying when we go to list a property. So they'll say things like, oh, I've got an I-10. Well, now they expire. So we're going to touch on that next week and hear about some of the pitfalls and ways to avoid them so that you get to the closing table smoothly with your foreign seller. So thank you so much. Have a great weekend. We'll see you next Tuesday.